The morning of September 16th, 1992, started like any ordinary Wednesday in London. Civil servants filed into their offices, traders took their seats on the floor. The Bank of England, one of the oldest and most powerful financial institutions on the planet, opened for business as usual. By nightfall, it had been dismantled. Not by an army, not by a rival government, not by any weapon known to warfare. By a phone call, a fax machine, and one man in a New York office who had spent years waiting for exactly this moment. His name was George Soros, and on that single day, he extracted over $1 billion from the British Treasury, while the British government spent £3.3 billion of taxpayer money trying to stop him, and failed completely. What happened on Black Wednesday was not a heist. It was not a scandal. It was not even technically illegal. It was a trade. And it remains, to this day, one of the most ruthlessly executed financial operations in the history of global markets. This is not just the story of one man's greatest trade. This is the story of what happens when a government chooses political comfort over economic reality, and the market sends the invoice. Stay with us, because by the end of this, you will understand not just what happened, but why it was always going to happen. Let us begin where the story actually begins. In Budapest, Hungary, in 1930. George Soros was born George Schwartz into a middle-class Jewish family. He survived the Nazi occupation of Hungary as a teenager by forging documents and living under a false identity. Not a metaphor. He literally lived as someone else just to survive. At 17,
he arrived in London with almost nothing. He enrolled at the London School of Economics, where he studied under the philosopher Karl Popper, who taught him that no framework for understanding the world is ever final, that every theory must remain open to being disproved by new evidence, that the man who believes he has all the answers has already stopped thinking. Soros would carry that lesson into every trade he ever made. Here is what almost nobody acknowledges when they talk about George Soros. The man who would one day force the British government to its knees spent years being ignored by the British financial establishment. He was not recruited. He was not mentored. He was not fast-tracked. He scraped for his first opportunity the same way most people do, which is by asking for it repeatedly until someone finally said yes. Eventually, he found his footing. He moved to New York in the 1960s. He built a reputation, quietly, methodically, without noise. In 1970, he launched his own fund. He called it the Quantum Fund. Here is what you need to understand about the Quantum Fund and why it matters. It was not a fund that announced its positions. It did not manage money for the general public. It was a tightly controlled vehicle for macro-level speculation, meaning it made large, highly leveraged bets on the direction of entire economies, currencies, and interest rate regimes. Not individual stocks, not sectors, entire national economic trajectories. Soros was not asking which company would do well next quarter. He was asking which governments were lying to themselves, and which ones were about to be proven wrong by reality. Now here is the chapter that social media never shows you. The chapter that gets cut from every 60-second clip and every inspirational reel. Before Black Wednesday, Soros lost. Badly. More than once. In a single month, the Quantum Fund lost over $800 million. The fund fell approximately 30%. That is not a rounding error. That is a catastrophic drawdown by any professional standard. And here is the painful precision of that loss. His chief strategist at the time had correctly identified that a major market correction was coming. The analysis was right, the thesis was right, the direction was right, but they had positioned the bet in the wrong market geographically, expecting the correction to originate in Japan rather than in the United States. Being right about the what and wrong about the where cost them hundreds of millions of dollars. He never ran from a loss. He autopsied every single one. He developed what he called the theory of reflexivity, which sounds academic until you understand what it actually means in practical terms. Most market participants operate on the assumption that prices reflect reality, that the market is essentially a measuring instrument. Prices go up when fundamentals improve, down when they deteriorate.
Soros argued the opposite. He argued that prices do not merely reflect reality, they participate in creating it. In 1979, a group of European nations formalized an agreement to keep their currencies moving within a defined range relative to each other. The logic was straightforward. Stable exchange rates reduce uncertainty for cross-border trade. If a German manufacturer knows roughly what a British pound will be worth in 6 months, the transaction is predictable and therefore manageable. The ERM was designed to be the scaffolding for what would eventually become a single European currency. Britain initially declined to join. For 11 years, Britain watched from the outside. In October 1990, under Prime Minister John Major, Britain joined the ERM. The entry rate was set at 2.95 Deutschmarks to the pound. That rate was, in the view of a significant number of economists at the time, too high. Not slightly elevated, materially, structurally overvalued relative to where the British economy actually was. Britain in 1990 was not in a position of strength. The economy had entered recession, unemployment was rising, consumer confidence was deteriorating. These are not the conditions under which you join a fixed exchange rate regime at an inflated valuation. But it was done. To maintain the pound within its ERM band, the Bank of England was required to keep British interest rates sufficiently high to attract capital into sterling. High interest rates mean expensive borrowing. In a recession, expensive borrowing is not medicine. It is the opposite of medicine. George Soros was watching. Stanley Druckenmiller was calculating. And the structural flaw at the heart of British monetary policy was becoming more undeniable with every passing month. Here is where the story demands your full attention. George Soros did not do this alone. By the summer of 1992, the consensus forming across major macro hedge funds in New York was that the pound's position in the ERM was not sustainable. This was not a fringe view held by one iconoclastic trader. It was the emerging institutional conclusion of some of the most sophisticated capital allocators on Wall Street. Fund managers discussed it over research calls. It was in the analysis circulating among proprietary trading desks. The Italian lira had already come under severe pressure and was forced to devalue and exit the ERM on September 13, 1992, just 3 days before Black Wednesday. That event was read by the entire professional trading community as a signal that the system itself was breaking down. By early September, the fund held approximately $1.5 billion in short sterling positions. Then came the catalyst. On September 15, 1992, the president of the German Bundesbank, Helmut Schlesinger, gave an interview to the Wall Street Journal and a German newspaper called Handelsblatt. In that interview, Schlesinger indicated that he believed European currencies needed to be realigned, and that one or two currencies could come under further pressure even after existing adjustments. He did not name the pound explicitly. He did not have to. The financial press interpreted his remarks instantly and unambiguously. The head of the most powerful central bank in Europe had just signaled that the pound was overvalued and that Germany was not going to cut its own rates to protect it. Druckenmiller walked into Soros' office. He laid out the thesis. Their $1.5 billion position was positioned correctly, he said. Soros looked at the analysis. He looked at the size of the position. And he said 4 words that have since become among the most quoted in the history of financial markets. Go for the jugular. The quantum fund scaled its short position to approximately $10 billion. They were not borrowing and selling $10 billion of a corporate stock. They were short-selling $10 billion of British pounds, directly challenging the capacity of the Bank of England to defend its own currency. And they were not alone. As the position built, other hedge funds and institutional trading desks across Wall Street recognized the same setup and began pressing in the same direction. Some had reached the same conclusion independently. Some saw the scale of what the quantum fund was doing and followed the momentum. The result was a coordinated assault on sterling, not formally organized, but functionally synchronized by the same underlying analysis pointing to the same inevitable outcome. The Bank of England held approximately $44 billion in foreign exchange reserves. The market, acting together, could mobilize more than that in hours. The government has finite reserves. The market has theoretically unlimited short-selling capacity. The government can raise interest rates to attract capital, but there is a ceiling on how far rates can rise before the domestic economic damage becomes politically and socially unsustainable. Soros understood this mechanism with clinical precision. September 16th, 1992. London markets open. The pound is already under pressure before the first hour of trading is complete. The volume of selling is unlike anything the currency desk at the Bank of England has managed in recent memory. The bank intervenes. It begins buying pounds at scale, injecting support into the market to hold the exchange rate within its ERM band. In the first hour alone, the bank spends £2 billion. The selling does not stop. By mid-morning, the British Chancellor of the Exchequer, Norman Lamont, authorizes an emergency rate increase. The Bank of England raises the base interest rate from 10% to 12%. That is a 2 percentage point increase announced in a single morning. The selling continues. Within hours, the government announces a second increase. Interest rates are raised again, this time to 15%. The government was now administering the largest interest rate shock in modern British history in a single day, in real time, trying to make sterling attractive enough to hold the line. Soros and Druckenmiller, sitting in their New York office, read each successive rate increase not as a signal of strength, but as confirmation that the Bank of England was a wounded institution, running out of options. They pressed harder. At 7:30 in the evening, Chancellor Norman Lamont walked outside the Treasury building in London and stood at a podium in the rain. The cameras were there. The whole world was watching. He announced that Britain was suspending its membership in the European exchange rate mechanism. The pound would no longer be defended at its current rate. It would float freely on the open market. Within minutes, the pound fell approximately 15% against the Deutschmark and 25% against the US dollar.
George Soros had sold pounds at the higher, pre-crisis rate. Now he bought them back at the devastated post-crisis rate. The spread between those two prices, multiplied across $10 billion worth of positions, produced a profit of approximately $1.1 billion in a single day. The British taxpayer had spent £3.3 billion defending an exchange rate that the market had decided was indefensible. That capital did not evaporate. It transferred from the public treasury into the accounts of private funds. Now, here is where this story demands intellectual honesty from all of us. And I want to be direct because this is the part that will divide the comments section. The British public was furious after Black Wednesday. Understandably so. Ordinary people had spent that day watching their mortgage rates threaten to spiral out of control. Businesses had scrambled to assess what 15% interest rates would do to their loan repayments. And then, after all of that chaos, after all of that fear, the government had surrendered anyway. Soros was cast as the villain, the foreign speculator, the opportunist who had weaponized capital against a sovereign nation and walked away with $1 billion, while ordinary British families paid the price. That narrative has endured for 3 decades. It still circulates today. And here is the uncomfortable truth that those 3 decades have revealed. He was right. Not morally right in a way that you have to celebrate. Not right in a way that means his interests and the interests of British citizens were aligned, but economically, analytically, structurally, right about the pound. The pound was overvalued at its ERM entry rate. The British economy was not strong enough to sustain that valuation while simultaneously managing a recession. The daily cost of defending the peg through elevated interest rates was being paid not by the Bank of England, but by every family with a mortgage, every business with a loan, every borrower in the country. After Black Wednesday, after the pound was allowed to float freely and find its actual market value, the British economy began to recover. Interest rates came down rapidly. The mid to late 1990s were among the most sustained periods of British economic growth in decades. The trade that the press described as breaking Britain may have, in practical terms, freed Britain from an economic arrangement that was quietly breaking its citizens every single day it was maintained. Now, ask yourself the question that nobody in official British political history wants to answer directly. If the pound was genuinely overvalued, and the government had access to the same economic data as the markets, and independent economists were saying it, and the Italian lira had just told everyone exactly what was coming, who was actually causing more damage to British citizens? The man who forced the truth into the market? Or the government that kept the fiction alive because the political cost of admitting the truth felt too high? I will leave that one in the comments. Here is what actually produced that trade. Lesson 1. The preparation was not measured in weeks, it was measured in decades. Soros spent over 30 years developing a theoretical framework for how economies and markets interact before he deployed it at this scale. He read policy documents. He studied historical precedents for fixed exchange rate failures. He understood the internal political constraints facing European governments better than some of the policymakers themselves. The trade took 1 day to execute. The education behind it took a lifetime. Lesson 2. The losses were not incidental. They were integral. $800 million in 1987. Positions throughout the 1980s that cost the fund significant capital. Soros treated his losses as tuition. He always collected his degree. Lesson 3. He was not speculating. He was concluding. By the time the quantum fund went to $10 billion short on sterling, the economic logic was not speculative in any meaningful sense of the word. Britain could not hold that exchange rate without continuing to inflict serious harm on its own economy. That was not a bet. That was a conclusion, supported by extensive fundamental analysis that the numbers had been confirming for months. Soros waited until the evidence was so overwhelming that acting with maximum conviction was the rational response. Patience in markets is not waiting passively. It is accumulating evidence until doubt becomes untenable. Whether you are managing a currency, running a business, or managing your own portfolio, the discipline to look at what is actually true rather than what is comfortable to believe is not a minor technical skill. It is the whole game. September 16th, 1992 is recorded in British financial history as Black Wednesday. The Bank of England did not lose because it was outmaneuvered by a more clever opponent. It lost because it was defending a position that reality had already abandoned. And somewhere in New York, on the evening of September 16th, 1992, a man who had arrived in London as a teenager with forged documents and no connections, a man who had swept floors and been ignored by the very institutions he would one day embarrass, a man who had lost hundreds of millions of dollars and returned each time sharper and more certain than before, quietly closed his position, collected his profit, and said nothing publicly for months. If this video gave you something to think about, not just something to watch, share it with someone who believes that markets reward the lucky. They do not. They reward the prepared, the disciplined, and the ruthlessly honest. See you in the next one.